Good day, and welcome to yet another one of our Answers Weekly Wraps. As usual, we'll cover some of the stuff that happened in the last week or so and how it affects you and your investments going forward. The three topics for this week are inflation, the Tesla investment day, and developed versus developing markets. So inflation. The inflation numbers of the last period or so have been a bit disappointing. Eurozone inflation, UK inflation, US inflation have all come a bit higher than anticipated. This means some of the assumptions being made around interest rate reductions and when they might be occurring may be misplaced, maybe a bit too optimistic. In addition, there's actually a belief now that some of the peaks in terms of the interest rate cycle might be a bit higher than anticipated. So what's been happening is because inflation is coming in a little higher than anticipated, people are now saying, firstly, don't expect a rate cut as soon as you thought it would be. So more because the rates will be cut later than we thought. Next thing, don't expect the peak interest rate level to be what you thought it was going to be. It might be a bit higher than that. Okay, and what this means is that interest rates are going to be higher for a bit longer, and that's quite negative for markets. The fact that people have been pricing in, a rate cut in the US by as early as this year, end of this year. People have been basically saying that we only got one more rate hike coming through. Those kind of things may be a bit premature, like I said, especially if inflation continues to be higher than anticipated. Now look, inflation in the US, for instance, is falling, but it's not falling by as much as anticipated. And the problem here is a couple of things. Firstly, the US, Europe, most of the world practice what's called, expectations management. What they do is central banks go out and say, we expect inflation to be no more than this much. And if it goes higher than this much, we'll fight to bring it down. The number in the US is about 2%. Inflation right now is about 6.5%. To bring basically 6.5 down to 2, it's a lot of pain. Bringing 9 down to 6.5 is not as difficult. There's some of these base effects. Housing prices increased by some this year. They'll increase by a certain percentage again next year to basically maintain a 9% inflation rate. But to get it down to 2, it's quite difficult, and it's going to take a little bit longer than anticipated. And if they are really serious about doing that, that's going to cause some serious economic pain. But if they aren't serious about doing that, what they do is now they have said, we see this is going to be 2, and it's not going to be 2. It's going to be maybe 4 or 5 when we start actually cutting interest rates. That means that their credibility in the market is going to diminish. And the market may be basically willing to go out and push things up again in order to get profits and whatever, because they may think that you really can't rely on the Fed or the ECB or whatever to come in and really crack down on the economy in order to fight inflation. If you don't believe what the ECB and the Fed are saying about inflation expectations and what they're going to bring it down to, people's expectations are going to change. You're going to start having workers anticipate a 4 or 5% inflation rate, demanding 4 and 5% wage increases, and maybe a bit more because of the earlier losses they've had. We're going to see companies pricing in that kind of wage increases, also price increases every year. Inflation will become embedded at 4 or 5%. And I think that is something that we need to be concerned about, that we are not seeing inflation falling as much as possible. And if it's not, and we are going to see more rate hikes than we anticipate, and we're going to see them for longer, we could see multiple years where we are at above 5% US interest rates. That is a very different scenario than the current market anticipated thing. And in my deep dive today, we'll talk about that in more detail. The next thing we saw was Tesla's investment day. And there was a little bit of information about, for instance, their operations in Mexico, some of the stuff about how many cars are produced. I think they're about 4 million cars at the moment, about what's happening with regards to the Cybertruck as well as a Cyber van. The usual kind of spiel about what they're doing. Now, for those that have not heard it before, this is my belief around Tesla. Tesla right now is worth more than any other car company in the world, even though they do not produce the most cars in the world. They may have a little bit more profit margin, but they do not produce the most cars in the world. And surprisingly enough as well, they're not the most research intensive of the car companies. Places like VW and Toyota spend a lot more money, multiples more money than Tesla does on innovation. Except that Tesla's innovation is a bit more, moonshot things like, for instance, AI and so on, whereas BMW and VW and Toyota are focusing on things like wind resistance and more shorter, more achievable goals. Now, when it comes to Tesla, because Tesla is so much more valuable than any other car company, and it's not going to be able to compete in the long term on manufacturing. It's not going to be able to compete in terms of build quality and so on, because these Toyota is a great car. A VW is a great car. You know, they've had decades, in some cases over a century of manufacturing, history behind them. They know how to make things, and they know how to make things very well. Teslas are cool, they're very fast, but the build quality isn't quite up to the scratch of like an Audi or whatever, right? Even though they are considered to be a luxury vehicle. The only way in which Tesla, which is, like I said, the most valuable car company in the world, that really doesn't have an advantage over the other car companies, and isn't even the biggest car company in the world, can be valued as the most valuable car company in the world, is around its technology regarding self-driving vehicles. If you don't have that technology come to pass, if everything else goes right, if Tesla can produce as many vehicles as it wants to, can get the gigafactory going, the runway in the world it wants to, can do everything else, but does not get self-driving vehicles, the company is worth a fraction, less than half of what it's worth right now. Possibly maybe 20%, possibly 10% of what it's worth right now. If, however, they can get that right, if they can figure out self-driving technology, the company is probably worth less than half, maybe even a tenth, as much as it will be worth. So let's just say $200 a share right now. No self-driving technology will be $20 a share. With self-driving technology, it will be $2,000 a share. That is the kind of gamble you're taking on Tesla. Whether or not it produces vehicles, whether or not it basically makes the vans or makes the trucks or makes whatever, that is kind of a side issue. If every single manufacturing goal was hit by Tesla, if they built the factories they wanted to, produce the vehicles they wanted to, they cannot be worth the current price. It's just too expensive for a car company. Even a car company that wants to do everything right that Tesla wants to do, it will not be worth as much as Tesla is worth right now. That's just not viable. Okay, so it's all about the AI technology with regards to Tesla, and quite frankly, that's been something that's been on the cards, according to Elon Musk, for every year from the last, say, 5 or 6 years. Quite frankly, it's looking like that's an incredibly difficult thing to do. It's probably technically possible to do. I mean, we as human beings are able to navigate the environment. We basically are able to process what's happening out there. But it's quite possible that full self-driving may be what's termed an AGI equivalent achievement. Artificial general intelligence is like the goal of all AI researchers out there. That it's quite possible that being able to perceive what's happening in the real world, react to it, and make actions in the real world, that set of requirements, as good as a human being, in order to do that, you basically have to achieve almost artificial general intelligence. That is a quite scary possibility, because that means that it's probably over a decade down the road in which we could achieve self-driving by Tesla. Like I said, without that self-driving, Tesla is not worth anywhere near what it's worth right now. And finally, here comes my deep dive into developing versus developed markets. I spoke to you earlier in the first segment about inflation and interest rates. Interest rates may be higher than expected for longer than expected. And if that is going to be the case, you do not want to be in developing markets. Okay? Now, the world in economics terms, right? We say developing versus developed markets. It comes down to one factor. Are you able to borrow in your own currency? Do you have enough of a domestic market that protects you from global, fluctuations? And so, can they lend you enough money? Or does the world trust you enough to lend you money in your own currency? That is a defining characteristic around markets. The US can do that. The US has US bonds. The Europeans can do that. They have Euro bonds. The UK can do that. Okay. Nigeria can't. Okay. Nigeria can't go out and borrow money at reasonable rates in its own currency. Why? Because it is believed that the Nigerian currency is too weak and will get weaker over time. And there's too much risk involved. And so if you want to basically lend money to the Nigerian government, you want them to pay you back in dollars or in pounds or in euros. Unfortunately, what happens is that when you see interest rates start to rise like this, a country can easily be caught in a bit of a debt trap. Okay? Like, for instance, if you basically owe a ton of money in a foreign currency, and suddenly the interest rates rise, and often this coincides with emerging market currencies falling in valuation because they can't keep up with interest rate hikes like the international markets can, because they already have to start with a high interest rate because of the high risk profile. So, for instance, the US does 5, Nigeria may have to do to be keeping to the same level, more than double that just to keep up. Like Turkey basically is also an emerging market. When the US is increasing interest rates and the Turks didn't want to do that, even though they were in the middle teens, high teens in terms of interest rates, their currency collapsed. Okay, and nobody wants to borrow or lend to a currency that's going to collapse, or lend a currency that's going to collapse. Why? You lend out a certain valuation, you get a much lower valuation, come back if the currency does collapse. So if you are in an emerging market and interest rates are going to be higher for longer, you are facing quite a high risk of a debt crunch. And this is all in an environment in which we have, for instance, higher food prices because of the situation in the Ukraine and Russia. But fuel prices, though they've come down a bit, are still reasonably high, which may be positive places like Nigeria, but most emerging markets it's not. Where we are seeing still issues in terms of demand from developed markets because, of course, the interest rates are high and therefore demand is lower because you're trying to combat inflation. All those factors come together and make it much less attractive to invest in developing markets during high interest rate periods where interest rates are rising or keeping higher for longer than anticipated, where inflation is going to be higher for longer than anticipated. The example I would use would be the 1970s, 1980s, some of the worst times to be in emerging markets. That was a time, which was most 70s, early 80s, where we saw some of the worst outcomes for emerging markets. Why? What we are seeing were high inflation rates. We were seeing collapsing or rapidly depreciating emerging market currencies, and we saw, for instance, those that remember the 1990s, there were things called the debt jubilee kind of events and so on, driven by guys. I think U2 was one. U2, the band was one of the primary drivers behind that, in which a lot of effort was made to forgive loans to emerging markets. And the reason for that was some of these markets, some of these countries were spending as much on servicing their debt, the interest on their debt, as they were on education and healthcare combined. That's obviously a terrible situation to be in. And why did they get into this situation? Because they had gone out and borrowed in dollars and so on. And when their economies had basically stumbled because of high interest rates, and because when their currencies had fallen because of the differential interest rates and so on, they were unable to pay that debt back as easily. And therefore, they had to put more and more of their budget towards repaying debt, or at least servicing the debt, then paying the interest on the debt. And that is something I think that we could be seeing again in the next few years if inflation, like I said, remains higher the longer. We've had at least a couple of data points now that says that it's been less, falling less than anticipated. But it's just a couple of data points. We don't have enough to basically guarantee a trend. But if it does occur like that, you're going to be seeing, interest rates remain higher for longer. And if you see interest rates remain higher for longer, emerging markets will suffer. In that scenario, you want to be in developed markets. You want to be in places that can borrow in their own currency. Europe, Japan, the UK, and especially the US, which is the reserve currency of the world, will really benefit from that scenario. Okay, that's it for today. Thanks for joining me again, and I look forward to speaking to you guys next week. Cheers.